This is 8-Minute Insights by Texture Capital, bringing you concise, expert insight for better markets. And now your host, Richard Johnson.
Hello and welcome to the latest episode of 8-Minute Insights, where I speak with industry experts and get their take on the most important issues. My name is Richard Johnson. I'm the founder and CEO of Texture Capital. We're a FINRA member and SEC-registered broker-dealer specializing in digital securities. So we help clients compliantly issue tokens representing equity, debt, revenue share, royalties, and so forth. And we operate a regulated trading platform for investors to buy and sell these tokens. As the bull run for both stocks and cryptos come crashing down, inflation's at the highest level in 40 years, and many analysts are forecasting a recession. I'm asking guests what comes next for crypto and markets in general. It's one topic, no prep calls, just 8 minutes of concise, expert insight for better markets. Today's guest is John Nance, the CEO of Dealbox. Dealbox is a specialty consulting firm focused on capital market strategy and technology. Dealbox uses both traditional and digital securities to enhance capital formation for early ventures and growth stage companies. Dealbox is also an important part of Texture Capital, so I'm delighted to have John on 8-Minute Insights and look forward to hearing his perspective. So let's get right into it, John. You've been around markets and capital formation for a number of years. How do you see us emerging from this crisis?
Yeah, thanks for having me on, Richard, first and foremost. It's been an interesting year, and I think most of what we should be thinking about going forward is every time there's a market disruption, I like to take a step back and say, what is it we missed, or what misinterpretation did maybe we not look closely enough at? And this go around, one of the things that's really concerned me is excessive risk taking and leverage inside of the crypto market specifically. So more recently centered around the crypto lending platforms over at Celsius and Voyager and the hedge fund over at Three Arrows Capital. One of the things that we didn't really understand was how were these value at risk metrics being taken care of? How is it that these lending structures were being put into place? And all the retail investor had to go off of was a lot of the literature that's on these websites or what's occurring on their social channels or what have you. But nobody was really asking these deep, thoughtful questions as to what happens in an if this, then that scenario. And so over the last couple of weeks and months, I can't help but look back into 2008 and think about what some of the seasoned investors were saying then, right? And I look at Warren Buffett's comments around derivatives being, financial weapons of mass destruction. Well, crypto has basically done that on steroids in this last, kind of correction in these markets as a result of some increased volatility. Is we were able to see just how exposed and what type of excessive risk taking and leverage these businesses were taking on. It's quite concerning from that standpoint. So I think before we ask ourselves, where is it we're going to go from here? How is it we really got here more recently? And then what might be able to change and how do we come out of that in a productive manner? So that's kind of how I start to think about these things before I drill too deeply down into, okay, then what, right?
Okay, so you mentioned two things there, leverage and risk taking. So what happens next for leverage? Obviously, these Celsius, these lending platforms that were over leveraged, they're not going to exist anymore, and a lot of their customers have lost money or in some kind of arbitration and so forth. So I think for the short term anyway, folks have learned their lesson on the leverage side. Certainly the individual investors, but what happens next though? How do we move forward?
Yeah, well, I mean, again, I've been thinking a lot about portfolio construction with respect to that question, how these other hedge funds and the venture capital firms think about what their projected returns might be, where do these assets fit? This is the conversation you and I used to have about crypto, many years ago, is how is it you really properly identify this asset class? And seeing all of this, I think what needs to happen is we have this sobering moment as market participants at large, and specifically in digital assets, which is, okay, these are the risk profiles of these assets. Here's where there's excessive risk taking and leverage that's available to, say, more people than it is in traditional financial markets. The average investor can't just go on to a TD Ameritrade and get level 3 margin approval to go trade futures, right? They can't do that. But this is what's happening inside of these platforms, indirectly today. And so I think that we need to, as a group of market participants, ask ourselves, what is it that we can do going forward to make sure that investors are, protected, and not from an excessive regulatory perspective, but do you really understand what the risks associated with these things are, right? And then knowing that, maybe everybody needs to take a step back, and when they think about the investments they make in these products, they shouldn't be looking for opportunities to 40x their investments in a matter of a year. That is not normal in financial markets. And I think what's now happening, and I hope that happens going forward, is people take a step back and ask themselves, okay, maybe we got a little bit aggressive. Maybe we got over our skis. We set unrealistic expectations for ourselves. How do we make sure that we don't continue to do that in the future? And those are a lot of the conversations I've been having with close confidants of mine recently, investors of ours who have lost quite a considerable amount of money in crypto. And I think that the ones that are not thinking about it in a professional way, I hear these kinds of comments around the idea of, how is it that we can get the next 40x, or how do we make all of that money back? And those are just the wrong things to be asking in this environment. I think it needs to be, what is it that we can do differently and better to make sure that we're protecting capital as we're investing it? And at the end of the day, this relates to markets at large as well, right? And coming out of all of the stimulus that happened as a result of the COVID pandemic, looking at central bank monetary policy over the last couple of years, let alone the last 14 of them. And we kind of reached this crescendo in the fourth quarter of last year and early in this year, of which risk-taking and exuberance and just overall disrespect for risk management kind of just felt like it was all out the window. And when you get to those points, that's usually when something bad happens, markets or otherwise. I'm sure that a lot of our listeners today can think about a time in their life where they weren't thinking about a risky situation properly, and as a result, something unfortunate happened to them. And I think that that is really what we're dealing with today, is kind of this hangover in financial markets of, oh my gosh, what mistakes did we make, and how can we do things differently? What does that mean for price motion? I'm not really sure. My belief at the end of the day is that central banks and monetary policy are the ones that are really driving asset price motions. And so barring some sort of reverse in course around the tightening that the Fed and the ECB have started and a number of the other central banks, I think that, it's going to take quite some time for us to see, recovery to all-time highs again in stock markets, bond markets, crypto markets, really asset prices in general. And again, you mentioned inflation when we started. Unless inflation gets under control, I don't think that we're going to get a reversal of the monetary tightening that we're seeing recently. And that is because these central banks, for the first time in 14 years, have been put on the spotlight by consumers across the world. And what they're basically having to do is say, yeah, we're affirming our commitment to that dual mandate that we have. And if they back off in a situation with inflation where it is now and the employment markets where they are now, they're going to have a massive, public perception issue. And they cannot simply afford to do that at this stage of the economy. And so, I think we're here for a little while. And my advice to folks is just kind of settle in and get comfortable. Don't make any rash decisions. Speak to advisors and friends and people of yours in your network that you can have open dialogue with, but settle in, because this is not going to be your typical V-shaped recovery that we saw during the pandemic. That's already proven true. And we all need to just kind of get comfortable for a little bit and lean on each other for help and support, and talk about these things in a productive manner, as opposed to just making rash decisions and thinking that this risk-taking environment that we've been living in is likely to continue. So yeah, that's kind of how I think about things today.
We are definitely in a risk-off environment, both on an institutional level and at a retail level. I think the phenomenon of what happened in crypto was primarily retail. Obviously, we've seen the big institutions go down, a lot of, fueled by a lot of individual investors. So I think the risk appetite is definitely off the table here. And you're right, people were, while we may be able to say, they were promised these returns and they were too good to be true, and then maybe they were deceived or whatever. I think a lot of the time people knew what they were doing, and they're like, I want, 100x returns or 1,000x returns on this. And I think Mike Novogratz came out recently and said, that's not normal. He's a macro investor for many years. That's not normal. 15% returns over a 10-year time period is amazing. You're not shouldn't be expecting, 1,000% in a year. So I think risk appetite is off at this point. But what role is, my last question here, what role is regulation going to play going forward here?
Yeah, great question. I mean, I brought up kind of investor protections, but not from an overregulated standpoint earlier. And, I think that what I would like to see, and I think what's healthy, is, again, around getting investors to basically attest that they understand the risks that they are taking, so that at least you've got some form of understanding between these financial institutions that are offering these types of products, assets, what have you, and making sure that those investors are, qualified, quote unquote, to be able to buy and sell these things. And, I brought up for those viewers that aren't familiar, I brought up kind of like margin clearance levels in traditional brokerage firms. Well, you can only trade certain financial instruments based on the level of approval you have for margin in these accounts. And each of these tiers, right, requires different, gatekeeping mechanisms, whether it's a function of, net worth or education or trading experience or professional designations. I would like to see something like that happen in the regulatory environment, not quite as strong. And I know that a lot of the people in the industry are kind of, pushing back on that idea. But I just don't think it's right when somebody takes, a $10,000, which is their quote unquote life savings, and uses it to put into a crypto lending platform that they then borrow against. And all those funds they borrowed, they now double down and buy the same thing. People in those situations, we should try to protect them from doing that, because quite frankly, no matter what they read or where they're going for, they just don't have the trading experience. They're not used to things like this. And one wrong move can literally blow up your entire account. And there's a lot of people out there that are lucky they don't owe money during these situations, right? Yeah. And so from a regulatory perspective, what I would love to see, and it's being fleshed out with the SEC and the CFTC right now, but I would love to see some kind of, mechanism in which we can start to move crypto accounts and products into a more traditional financial framework in terms of who's allowed to buy and sell those things.
Yeah, no, as you were saying all that, your one word was popping into my head: suitability. There's a whole suitability framework, and as a FINRA broker-dealer, SEC registered company, we have to make sure that the investments are suitable for the investors, and we collect information about them. I think in a lot of cases here, we don't need new regulations. We need companies coming in and following some of these existing guidelines that have been established and proven relatively successful over the years to move forward here. Anyway, we are out of time, John. It goes by quickly, but thank you for your insight here. We may have to have you back on a show because we've got a lot more to talk about. But thank you for being a part of 8 Minute Insights.
Yeah, I would love to. And thanks for having me, Richard. Appreciate everybody for listening.
Take care.
This has been 8 Minute Insights. Be sure to follow Texture Capital on LinkedIn, where we will release a new episode every week. You can also find us on Twitter at texture_capital and on the web at texture.capital. The foregoing discussion is for information purposes only and does not constitute a solicitation to buy or sell securities. Private securities offerings are not registered with the SEC and are considered highly speculative. An investment in private securities may result in the loss of your entire capital contribution. Blockchain is a new technology and unproven in financial markets. There is no guarantee that tokenization will enable any secondary market liquidity in the future, and your investment may remain illiquid.